We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Krauth, silver investor and analyst, and also the author of the new book, The Great Silver Bull. Thanks for joining me today, Peter.
Tom, it's a pleasure to be here with you.
So obviously the talk for many months has focused around inflation, and some have said that this will define this coming decade. So how are you seeing the inflationary outlook at this point?
I'm one of those who have said that. I do feel that inflation is going to be a defining feature for the rest of this decade, notwithstanding what central planners want us to think. In fact, as far as I'm concerned, it serves their purposes, and their hands are tied. They know that given current debt levels, both as much on government side as business side as on the individual side are much too high. They realize that they cannot raise rates significantly and not to make enough of an impact. And so ultimately, I think it means that inflation will just continue running because there's really very little that can be done to end it. So yeah, it's absolutely a defining feature. And I think wise investors need to look for alternatives, strong alternatives that have proven themselves over decades and even millennia. And silver is a perfect fit for that.
So, obviously you're quite focused on silver and, being probably one of those alternative assets that you just mentioned. So why do you see silver really as a generational opportunity?
So for a couple of reasons. I mean, if you look at how undervalued silver is, I think that's an important point to be made. If you look at the highs that were clocked by most metals, precious metals, platinum group metals, base metals in 1980. Mm-hmm. So we're talking several decades ago, and when silver and gold both peaked. Silver remains the only one of all of those metals that is below its 1980 high. So silver is cheap on that basis. It's cheap on an inflationary adjusted price basis. And if you look at what happened in the 1970s, gold was up 14 times, so 1,400%, and silver was up 37 times, so 3,700%. And I think that we're in an environment that's similar to the 1970s. Not exact. I don't think history repeats exactly. It certainly rhymes. And some of the differences are that in the 1970s, the debt to GDP ratio in the US, for example, was about 35%. So much, much lower debt levels. Today, it's at 130%. So to think that central banks can raise rates, that speaks to what I was saying earlier. To think that they can raise rates enough to actually dent inflation, I think is pie in the sky. That simply will not happen. Inflation will run. People will have to get used to it. And it's unfortunate because if you look at what inflation does to your buying power, I think it's at 5.4% inflation over about 6 or 7 years, you lose 40% of your buying power. So $100 is worth $60 in about 6 or 7 years. And that's at 5.4%. We're running 8.5% in the US right now. So people really, really need to wake up to inflation, what it does to your investments. And they really, if they don't want their retirement to be stolen by inflation, they need to look at proven hedges like silver that, as I say, have proven themselves over decades and even millennia.
Mm-hmm. So why do you think it is that silver, as you mentioned, is the only commodity that is trading below its 1980 high? And couldn't the argument be made that 1980 high was a bit of an anomaly?
So yes, that I would agree that there are certainly some factors that pushed silver probably exceptionally high. What I do talk about in the book being the silver squeeze that came from the Hunt brothers, and that was it reminds me a little bit of kind of what took place last year, end of January when we had the silver squeeze. that took place because of social media, I guess a big social media drive. But silver is certainly used in a lot of applications. It's crucial to industry, and it has proven itself as money as an inflation hedge and value protection over years. But silver is a much smaller market than gold. And that's something else that I talk about in the book. And it being such a small market, it doesn't get the attention that gold gets. It's about 1/10 the size of the gold market. If you look on a supply basis every year, gold being about, I think it's 270 billion, silver being worth about 27 billion annually. So silver being such a small market versus gold, it means that silver tends to be a lot more volatile. Mm-hmm. It actually does outpace gold's returns in bull markets. And so you definitely want exposure to silver. And it tends to outpace gold bull markets or precious metals. It tends to perform well and outpace gold and precious metals bull markets in the latter half of those markets. And so it's, as I say, it's definitely a metal that you want exposure to. You may want to do so in a maybe more limited way because of its volatility, but the volatility should not be, in my view, something that any investor would want to use as a reason to not participate in silver investing.
Mm-hmm. So I'd like to take a step back, if we could, and think about some of the, let's say, the fundamentals of the silver market for a bit. Why does silver have a very quirky kind of supply profile, and how much of it historically is used for industrial purposes?
So if we look at even recent numbers, historically, silver is about 55 or so percent industrial, the balance being split across things like investment, jewelry, silverware, et cetera. And in terms of the quirky supply profile in that, I have a chapter sort of dedicated to that as well. And the difference between silver and many other metals is that only about a quarter of silver is from what we call primary silver mines. The rest comes from mines that produce other metals as their primary metals. Gold mines, copper mines, lead zinc mines. So 3/4 of silver comes as a byproduct of producing these other metals. So what happens is that silver is what I call supply inelastic. If the price of silver rises, the producers of silver in many cases, so 3/4 of silver production, because of it being a byproduct, the producers of silver in those cases are not really that motivated by higher silver prices. What they tend to do is, accept a higher silver price. They're happy that boosts their bottom line, but because it's relatively insignificant for them, they just accept that higher price. And if even a primary silver miner, and this is an interesting sort of point to note in terms of how these things play out, the subtleties of it, even a primary silver miner oftentimes needs to see a higher and sustained higher silver price for maybe as much as a couple of years before they decide, okay, let me look at ways I can boost production. And even that's got, lots of complexity, but one of the ways that they may react may not even be to simply try to boost production, but they might say, okay, so silver is now, say, trading at $35. It's an average $35 or $40 for a couple of years. I'm making, plenty of profit. I've got some lower grade ore. Why don't I start producing that lower grade ore? And so they may sustain the same kind of profit that they had at a lower silver price, because now it's at a higher silver price, although they're actually potentially producing less silver. Mm-hmm. So it may actually limit the silver supply, a higher silver price, because of how the miner reacts to it. So it is very much a quirky supply profile that the silver has, and it plays into exacerbating supplies, and so that could help drive silver prices even higher. In fact.
Mm-hmm. So in times like the last 2 years where we saw investment demand really pick up, how high did that demand get as a percentage of production, let's say?
If you look at one good example is, it is an outlier, but what happened in 2020 when we had the pandemic and people flocked to gold and silver as chaos hedges and uncertainty hedges. there was a lot of silver ETF buying in particular, both physical but also ETF buying. And globally, silver ETFs actually took in about 330 million ounces of silver, which was about 4 times the previous year's level at about 83 million ounces. So that was really dramatic. And I have actually a chapter in the book that talks about silver that I call being sticky money. So I say silver is sticky money. And I have a chart that looks at the price of silver overlaid with inventories in silver ETFs. And, a couple of years ago, when I started looking at this chart, what I realized was that it's very interesting how even after the silver price might have run up and then takes a dip, in some cases, it might be a considerable pullback. There is very little selling that takes place in silver ETFs in terms of their silver holdings. So since 2006, when the first silver ETF came to be, the SLV, silver holdings in silver ETFs globally have climbed dramatically and have very rarely backed off. And as I say, as I like to point out, very interestingly, barely budge even when you get big sell-offs in the silver price. So people who buy silver through silver ETFs tend to actually hold on. Those in a net basis. I mean, those silver ETF units or shares may transact a lot and may get bought. But the point is that there is substantial buying, and that holds up the holdings in those silver ETFs. So the number of ounces, have stayed high and have continued to climb ever since the inception of the SLV.
Mm-hmm. So you had mentioned that it really tends to outperform gold in the latter stages of a bull market. Why is that, Peter? Again, another sort of quirky aspect, but silver being, again, a much smaller market than gold. If you look at what's taken place previously, is that, gold gets most of the attention. It starts to build up. It's the sort of, the better known hedge, so to speak. It's the go-to initially, at least. And so people often are late to the party. They'll see gold go up. Let's say gold is right now around close to 1900. Once it passes 2000 and continues to climb, let's say gold, goes up. I'm not even going to make a prediction right now, but several times, let's say higher even than it is currently. Mm-hmm. It's certain that it's going to attract a lot of attention. And if people see gold at multiple thousands of dollars per ounce, they're going to feel like they've missed that opportunity. They're going to look for alternatives. Silver naturally becomes that alternative. They'll see it at a much lower price per ounce and feel like, okay, silver has been rising as well, but I can get a lot more ounces per dollar for silver than I can for gold. I'm going to buy some silver. And it's a much smaller market, as I alluded to earlier, and that just sort of feeds on itself and pushes silver up dramatically. Again, as I say, in the latter stages of a precious metals bull market. So, is the gold to silver ratio informative to you, and how low do you expect it to get?
So, I mean, yes, it certainly is informative. It's not a perfect indicator, but over time it is very useful. The average, say over the past maybe 40, 50 years or so, is about 55 to 60 ounces of silver per ounce of gold. Right now we're trading at about 80, which is, interestingly enough, a level at which it tends to peak. So it has peaked higher, that's for sure. But if you look, again, as I say, over the past 40 to 50 years or so, the ratio peaks typically around 80. And at that point, when the ratio starts to fall, that's when, in fact, both gold and silver start to rise, but silver rises at a faster pace and starts outpacing gold. So when you see the ratio at 80 and then start to fall, that's when you really want to start paying a lot of attention to silver and look to perhaps accumulate silver. Especially if you see that it's in a rising environment, it starts to rally. Where have I seen it in the past? Well, the ratio bottomed in 1980 at 15. That was when silver reached $50 and gold reached $850. And then after that, the next low came in 2011 when silver bottomed at 30. Gold hadn't quite peaked yet, but was on its way to 1900. And I think that we really should look for a new low ultimately in this bull market. I'm not necessarily expecting 15, but I do think we're going to see 30, perhaps below 30. But that's where I think we should really look for a clear sign that perhaps silver has even peaked if we see it somewhere at or below 30.
Mm-hmm. So when we think about these, let's say these macro drivers or macro factors that are affecting the metals prices, how do real rates affect the appetite for silver?
So I talk about that also in the book. That's what I call the secret key. In fact, if you look at the best single indicator, at least that I know of, for whether gold is in and or is likely to, is either heading towards or likely to be in and stay in a rallying or a positive price environment, is real rates. So that's essentially the rate of return, the rate of interest minus the inflation rate. And if you chart, which I do, and we can show that chart. If you look at gold versus the real rate of return, gold tends to move inversely, very clearly inversely to the real rate. And in 2018, the real rates peaked and then started falling, and that's when inflation started to rise and rates started to fall. And we've been in a rising price environment for gold ever since. And interestingly, if you create the same chart of real rates versus silver, it's almost identical to the gold versus real rates chart. And so that, again, for me at least, is a very clear indicator as to where silver is heading. And we're very much in negative real rate environment. And I believe with inflation high and central banks unable to raise rates significantly, we're going to remain in a negative real rate environment for several more years. And that's a perfect setup for silver.
Do you think that home prices have any correlation or predictive value to you when you're setting price targets for silver? There's a great chart on that as well in the book that compares silver and home price charts. If you look at what happened, when silver peaked in 1980, the price of silver to the average price of a U.S. home was, I believe, down to 1,500 ounces of silver. When that ratio peaked, which was around 2000, it took about 55,000 ounces of silver to buy the average U.S. home. So right now, I believe we're down to about 18,000 ounces. If we got somewhere below, say, 3,000 ounces, it's interesting. I just realized you can make a parallel perhaps with the gold to silver ratio. So 1,500 ounces of silver for the average home price in 1980, it was a 15-to-1 gold to silver ratio back then. If we see something below 3,000 ounces of silver to the average home price, which I could easily see happening in the next maybe 5 to 10 years, that to me is going to be a very clear indicator. And, anyone who owns a decent amount of silver could certainly look at cashing in, and on a relative basis, home prices should be relatively cheap compared to silver at that point, and make the switch. It would be probably a very lucrative thing to do. Mm-hmm. So, you just mentioned a couple of the maybe factors that we could see when we're, let's say, approaching the top of that bull market. Are there any others that come to mind that you think we should be aware of as we're, approaching maybe the end of that bull? Because obviously it's not going to go on forever, right?
Exactly. And that is in my last chapter. provide silver peak indicators. That's what I call them. And I have 4 of them. One of them is the fear of missing out, which we talked about at the beginning. And so anecdotally, I mean, in 1980, you had people lining up for blocks to buy silver around the time that it peaked. And, that wasn't necessary. That was in the month of January. So if you could imagine people lining up for blocks, in the Northern Hemisphere in cold environment because they want silver that badly. After having run up so dramatically, well, that would certainly be something you'd want to look at. It's that cocktail party indicator. You've got the gold silver ratio that we talked about. And that, as I say, I think anything around, say, 30-1 silver to gold would be a time to start looking at a potential high in the silver price. There's also the Dow to silver ratio that I've looked at. And interestingly, what has happened is that in the 1970s, the Dow to silver ratio had 2 waves. It started around 1970 and then had a wave down to about 1974, 75, when silver temporarily peaked. And then the ratio rose again and then eventually started to fall back off dramatically. And then eventually the ratio bottomed, also like the gold silver ratio. That was in 1980. So that would be something to look at, the Dow silver ratio. And finally, the silver real estate ratio that we just mentioned. So these are 4 factors that if you look at them together as indicators, and they all are potentially pointing to a peak in silver, when you have multiple indicators that way giving you that same kind of signal, then yeah, you may want to be starting to look for the exit. And I also talk about how to exit. It doesn't have to be an all or nothing kind of thing. You can certainly look at layering out the way you could layer in when you buy a silver investment and start selling perhaps part of your silver portfolio in tranches and do that, 25% at a time. If you're not sort of completely convinced that we've reached a peak, you can do that. Perhaps you'll layer across that peak and you could still do exceptionally well. So yeah, I mean, these are ways that you can mitigate your risk. And I'd certainly advocate, following these kinds of indicators.
So, looking forward a little bit, Peter, I'd like to kind of get your take on what we could see as new demands for silver over this decade. Could we see, let's say, maybe a silver-backed crypto start to gobble up supply in some of the same ways that ETFs have over this past decade, as we talked about already?
Yeah, I mean, I have a section that's dedicated to central bank digital currencies and crypto. And, if we can talk a little bit about central bank digital currencies, I kind of want to make sure that people understand that because these are being talked about a lot lately. And although they're crypto, they have nothing to do with, or they're nowhere close other than perhaps the way they work in terms of, facility of use and et cetera, and speed of transactions. They have very little else in common with something like Bitcoin that has a limited supply, which in my view is, one of its biggest features when you compare it to gold and silver. But central bank digital currencies, in fact, I think are very likely. I think that they're going to exacerbate the inflation environment that we have because it'll make it that much easier to, in quotes, print money and to distribute money. And there's a really interesting point that I read about recently, how in the UK, the central bank was instructing members of parliament to ensure that any central bank digital currency that they would issue would be what they call programmable. And so that makes my skin crawl. I get shivers when I think about that because the idea is that they could potentially say, well, we think that it's okay for you to spend your digital currency on these things, but not on those things. What will that mean? Well, they get to decide. And so that to me is ludicrous, an incredible loss of both privacy and liberty. And so again, people should not mix up central bank digital currencies with high quality cryptos. I think that ultimately we're going to head towards a reset of some kind in the global financial system. That's going to drive people back to real money. real money being historically what we've seen, silver, gold in particular. These have proven themselves over millennia. But I think you really can't deny the benefits of crypto. I mean, you have what we call frictionless transactions. In other words, very quick, seconds, fractions of a second, zero cost or near zero cost transactions. There's a lot of utility to that. You can transfer value in very little time, but you're transferring value, especially if you've got something that has and holds value. And so I think that ultimately, in my view at least, the perfect kind of crypto would be a silver and or gold backed crypto. And I think if a reset of some kind, globally on a financial basis becomes bad enough, that you'd have people flocking back to silver and gold. But if you can combine that with crypto and then provide the ease of use for transactions, then you've got it made. One last sort of point on that, it was interesting that I think it was when gold peaked in early March over $2,000. The two largest gold-backed cryptos had together combined reached a market cap of over $1 billion. So what that meant to me, at least, was that you had an interesting combination of things happening there. You had crypto, a form of crypto, obviously, attracting a lot of attention and buying. And then you had a bit of the mix of precious metals that's backed in crypto. So you had people who were comfortable with crypto and looking for the precious metals aspect and backing to it, saying, okay, this is a place that I can allocate some funds. I'm really comfortable with this at this point. And I think it speaks a lot to that sort of blend of precious metals and crypto. So that to me spoke volumes in terms of what was happening in these two sectors combined.
Yeah, and to your earlier point about, let's say, the programmability of these CBDCs, obviously, both of us being in Canada, we saw some of those capital controls come in, and the ease at which it could be implemented if you are saying something that isn't towing the line, I think really becomes a major risk with a system like that, right?
Could not agree more. Exactly. I mean, it's the ultimate, control dream, so to speak, for a central planner to be able to have something that everybody uses all, on a daily basis to do transactions, which is, everywhere and all the time, to be able to have a level of control in terms of, what those transactions entail. And so, yeah, that's quite scary. People need to wake up to the risks that entails and realize, what the implications are and how they can look for hedges. And, precious metals have a lot of the answers to that.
And of course, there's I believe I saw a little section in the book about really the idea of becoming your own central bank. So that is another part of, not only, let's say, making money or generating alpha with silver, but protecting yourself in some ways and your ability to transact in the economy, right?
That's right. I mean, if you think about it, physical silver, physical gold, they have no counterparty risk. They have no access risk. You don't have to worry about having the internet or electricity to access them. They are fungible. They are consistent. They're virtually indestructible, and they're private. They really have all of the ideal characteristics for what you'd want money to be. And so that's why I think, you do have to be, I think, forward-looking and progressive in the sense of, what should money be? And that's why I think if you look at a silver-backed crypto, for example, that really is, to me, again, sort of the ultimate way to the ultimate money. And if we get there, there's going to have to be obviously a certain level of trust because someone will be holding that silver to back the currency, the cryptocurrency. But if we can get to that point, as I say again, it's really the ultimate protection in terms of what you'd want your money to be. And I mean, if something like that gained sufficient buy-in, then you'd have a ready market for silver producers. And that would take, what we've got already with silver ETFs to a whole other level. I mean, it would be another order of magnitude. Mm-hmm. And you're not limited really by the silver price, because you can have fractions of a crypto. I mean, it's easy to talk about, multiple decimal points. So, a really high silver price would not be an impediment to transacting even small amounts.
Mm-hmm. So you mentioned stability in the metals prices. Is it possible that investment for institutions like pension funds or the like start buying silver, or is it too volatile when compared to gold?
Yes, I mean, I do think that it is volatile compared to gold, and that's why institutions typically tend to turn to gold when they look for a hedge, if they're going to look for alternatives of this sort. But in some ways, what that does is it gives an advantage, and I do talk about that as well. It gives an advantage to the smaller investor, because the larger investor won't go to silver in terms of it being so small of a market and them having sufficient access to sufficient quantities. That's not to say that some more sophisticated larger investors won't. I mean, you've got some private investors with deep pockets. You've got some family offices. There are ways for sure that some, I'm going to say, higher level or higher net worth investors will play in the silver market. But as I say, the relative size of silver versus gold makes it an interesting place for the smaller retail investor, because they can more easily participate. They can find opportunity. They can take advantage of the volatility. They can, because of that volatility, they can, because silver gets pushed out of whack on the up and downside many times, they can be more patient, and they can buy into silver and silver investments when they become more unfairly undervalued. And so that just creates a lot of opportunity. I really, I do say that silver is volatile, but there are so many ways to mitigate the risk that you have from the volatility, through position sizing, through selling when it's overvalued, accumulating when it's undervalued, and on and on. It really shouldn't be a reason to limit your access to the silver market.
Mm-hmm. So, when we think about the silver market, as you're mentioning there, Peter, what do you see as a reasonable breakdown for a properly constructed silver portfolio?
So I have something I came up with called the silver map system. And that really is that, first of all, S is for silver. So you should own some physical silver, even if it's a small amount. I say somewhere around 10% of your overall silver allocation, if you're going to build a silver portfolio, ideally should be in physical silver. And then from there, the M in the map is for the miners. And as far as miners go, so if you look at your entire portfolio, let's say being silver, so say 10% is physical, 50% I would allocate to things like silver ETFs and the larger producers and the royalty companies, 20% to the growing producers and developers, and then another 20% to the juniors, being explorers or sort of newly or near-term producers. So that's how I would break down the silver portfolio. And so in the silver map system, which is a very sort of simple concept, S for silver, M for miners, A for allocate. So that's how you'd allocate across these different categories in silver mining and silver and physical silver. And then P is for profits. So take profits when you have them. If you get a double, and especially a junior, you'd want to sell half. That's just, a bit of a rule of thumb. Take that money, either bank it, look for another company that you'd want to invest in that you've been watching or that is undervalued at that point as you feel. and again, sort of mitigate your risk that way. So again, there are lots of ways you can minimize risk, but you absolutely want exposure to this sector.
Mm-hmm. Excellent, Peter. Well, I think that's a pretty good overview of the silver market and some of your thesis on it. Of course, the book goes through a lot more detail. Why don't you tell our listeners where they can find it, if you don't mind?
Sure. So the book is available on Amazon. On just search The Great Silver Bull. You can go to a website I have to just know more and about the book, a little bit more about the book, and sort of keep track of any developments. That's thegreatsilverbull.com. And to follow my newsletter, you can go to silverstockinvestor.com and learn about the way I approach investing in the silver market in terms of silver miners. And I cover everything there, everything from physical silver all the way to junior explorers. It's once again, it's an area that people really need to look at. The investing environment has changed dramatically. In particular, in the last 6 months, I do believe that we're at the end of a long-term stock and bond market. And so people need to look for hedges and alternatives, and silver really does fit that bill.
Mm-hmm. Excellent, Peter. Thanks so much for your time today and highlighting maybe an alternative to, like you said, the stock and bond market, and to be able to maybe preserve some of that purchasing power that people have accrued over the years.
It's been a pleasure. Thanks so much for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.